Ethereum over recent weeks has rallied massively. That's largely thanks to the approval of spot exchange traded funds, ETFs, in ETH, which has taken place in the USA. And also a lot of that has been down to crypto, perhaps an unlikely US election issue. So many amongst us feel it might be the start of a new altcoin. So hopefully some of you are already sat on some impressive gains, maybe limbering up to make some even greater ones. But what we do need to bear in mind, whether we're in the UK, the US, or most other parts of the world, not all, we know what gains mean. Gains mean taxes. Are you worried about losing a chunk of those precious gains to the taxman? Are you confused about what events might lead to a tax charge as well? So not just simply turning your crypto into cash. Are you sure about what you can do with your losses on your meme coins? Are you considering maybe becoming non-UK resident to help with your tax woes? Who knows? So in this video, what we're going to try and do is break down everything that you need to know about UK taxes, everything that you need to know to stay ahead of the taxman and keep more of your hard-earned crypto gains. So we'll cover the impact of the latest ETH rally. We'll look at the ins and outs of a HODL strategy and how every crypto exchange, or every time you swap crypto, how that manifests itself as a taxable event. We'll look at how you can handle your losses, completely navigate the capital gains tax regime, and as a doffing my cap to my previous comment, we will have a look at potentially the benefits and risks of becoming a non-UK resident individual. The ETH rally is a perfect example of that. Ethereum is now trading at 304% higher than its lows in June 2022. And let's not forget about the bullish trends in other altcoins as we approach the next phase of the 4-year coin cycle. This is the time to see the most gains. One more thing to keep your eye on: Bitcoin ETH dominance. I think again over the weeks we have seen a little bit of a shift in favor of Ethereum, which could mean exciting times for people holding on. As Bitcoin takes a backseat, potentially with ETH stepping out into the spotlight again, this could mean more gains for those of you who are holding on to their moonshot bags. Meme and AI coins are leading the present market, driving major growth and delivering some impressive returns for those who hold them. If you have been these trending assets, quite frankly, you probably sat on some fairly impressive gains already. So if you are a simple buy and hold investor, you're in the right place. We'll start by breaking down the recent ETH rally and what it means for your profits. We'll explore the popular HODLing strategy and how it can help you outsmart the taxman. Next up, we'll dive into the nitty-gritty of taxable gains. Every swap counts, and you need to know how to track them all. Easier said than done. If we're talking about gains, sadly, in the world of crypto and any investment, we need to also talk about how we handle those losses. How do we turn those crypto lemons into lemonades? Well, we can do that by offsetting the losses against the gains. A silver lining to a grey cloud, but a silver lining all the same. For those of you who don't like to do things by halves, we'll look at some more serious measures, such as discussing the benefits and risks, of course, of becoming non-UK resident as part of a cunning tax plan, effectively to escape the CGT regime. We will then wrap up with some key takeaways and practical tips to help you to manage your crypto taxes like an absolute pro. So let's get started. Welcome back. All right, let's talk about what is behind the current, as I said at the outset, 304% up on the doldrums back in June 2022. So if you bought back then, pretty much any time in the last 2 years, you're likely to be sat on some pretty nifty gains. What's been driving that rally? Well, first and foremost, it appears to be the approval for the ETH ETF over in the US, kind of, I guess, mirroring what happened with Bitcoin right at the beginning of the year. So that's been a massive factor. It opens the gateway to institutional investors, and hopefully that increases the price as the demand increases. But also, I think for ETH, for Bitcoin, for the wider crypto market, it's a stamp of credibility, isn't it? If these funds can get approval from the greyest of grey regulators, then that must say something, mustn't it? Tax position, and we do need to understand how to stay compliant with the taxman in the UK, HMRC. Obviously, the UK tax system, incredibly complex. It's frankly silly and needs to be burnt with fire, but it is as it is, and we need to know how to deal with it. The starting point here must be that gains are taxable. So if you're not starting from that position or don't believe that very basic fact, I implore you to go and look at some other channel. Go on, off you go. Gains are taxable. Don't cling to one or two historic life rafts that are out there. Way back in 2014, HMRC suggested that in one of their guidance papers that winnings could be so speculative that ultimately they might be treated as gambling winnings. That's absolute hogwash, and HMRC have resiled from that position since then. The other gem that they shared back in 2014 was that potentially the gains at that time on Bitcoin were the equivalent to gains and losses on foreign exchange, or the exchange of foreign currency. Again, in the UK tax code, there are exemptions where you are trading in and out of currency for personal use. But again, it's a hogwash, and HMRC have resiled that position. But as I say, there are some people out there who still cling to these premises like fiscal life rafts. Fall for it. So as we've said, HODLing is it's pretty low when it comes down to the amount of time it's going to take up. All you're going to do is sit on your investments for a period of time. Does it have any downsides? Well, as with any strategy, it does have its downside. Clearly, if you are sitting like King on the beach, not taking profits from your investments, and there might come a time actually where those profits and you lose your entire stake. So many people would certainly advocate that you always have to keep taking profit in the crypto world, because until you do take it out, then you have nothing other than potentially gains and paper losses. So part 2, a HODLing strategy: hold tight and outsmart the taxman. A pithy title if ever I heard one. So this is one of the most strategies in the crypto world, HODLing. So for the uninitiated, HODLing means holding onto your crypto assets for dear life. So HODL. No matter how the market gets, no matter how they sort of are impacting on your particular crypto, we HODL on for dear life. When the value goes up, we HODL for dear life. It's all about having diamond hands, I guess. Why do so many people this particular strategy? Who knows? It's always nice to have a little bit of faith. Once upon a time, perhaps, we went to churches and temples and things like that. Maybe for some of the crypto world, this is the equivalent, our blockchain place of worship. Who knows? But I'm a dullard when it comes to tax. HODLing is probably the simplest and most straightforward of all the great tax plays. If you don't sell your crypto, then you're not triggering any taxable event, are you? So that will keep the taxman at bay, because simply you don't have a tax liability. So one important thing that I think it's worth setting out at the outset is that if we trade one coin for another, so not just going from crypto into fiat, but from, say, ETH to Solana, then that is a disposal for capital gains tax purposes. This is probably the one real sort of compliance issue which comes up over and over again. And of course, it doesn't take somebody to be that active in the crypto world. Lots and lots of disposals every time they switch in and out of their favorite crypto. So just to put that into a crypto shaped picture, if you swap your ETH for that's a taxable event. If you exchange your ETH for a shiny new Bored Ape Yacht Club NFT, then that's taxable too. If you convert your fiat into ETH, so you're going on ramp, so you're sticking some cash maybe onto a Coinbase and then purchasing some crypto, the actual on-ramping of the cash, there's no disposal there because cash is not a chargeable asset for CGT purposes. So the taxman, he doesn't miss a beat, does he? And neither should you. So make sure at all times you're keeping good records. Good records can save you some big headaches further down the line. And if you're like me, the temptation is always to worry about records and keeping details of all your financial transactions much further down the line. But when you try and look back at these things, maybe 12, 18 months later, it's much, much harder. So let's keep some contemporaneous records. If we can use software, some specialist tax software particularly, then I would heartily recommend that, particularly for anybody who is moderately active in this space. Abandon your Excel spreadsheets. That would be my advice, and embrace software which can pull in the transactions via APIs and other plugins with centralized exchanges and your things like MetaMask wallet and all those kind of things. Makes your life much, much easier. You have to pay a few quid, but it will be transformative in terms of your financial record keeping. Now, should you stay firmly diamond-handed and keep holding on to your ETH because we think the prices are going to go up? Or should you take some profits? Should you sell now? And once you take those profits, I bet that one or two people out there who are thinking, should I bother declaring it to HMRC? How will they ever know? Well, believe me, they do know. And when they find out, and they've had to go to the effort of finding out, that is potentially a world of pain for you. So however you proceed in crypto or any other sphere of life, always assume that you are doing things with all your cards the right way up on the table. Think how you're going to explain what you've been doing at the friendly neighborhood tax inspector. So we have spoken about capital gains tax quite a bit. It's perhaps worth pausing here for one slight minute and pointing out that it is more than likely that any of your profits will be within the capital gains tax regime. You could be considered to be trading for tax purposes. That is where your crypto trades take place on a deliberate and organized such that those activities are undertaken on a more commercial basis. And if you're trading, then those profits are subject to as well. So if you are an individual and you're buying and selling crypto, then generally speaking, the top rate of income tax being higher than the top rate of capital gains tax, and also those national insurance contributions mean that if you move over from investment subject to capital gains tax and a top rate of 20% into trading, where you're in income tax, top rate of 45% and probably 2% NIC there, then it is essentially like falling off of a tax cliff. So you need to be careful about that. But it is exceptional that somebody will be treated as a trader. Of course, another downside But counterintuitively may also be an upside, is that you're always at the mercy of changes in tax rates as well. I mean, in the UK at the moment, the top rate of capital gains is 20%, which is pretty low and much lower than the current income tax rate. So you could be missing out profits at a rate of 20%. Now, a pessimist out there, and a pessimist might classify themselves as a realist in this scenario, might say that actually, if we have a change in government in the UK, then some form of equalisation between the rates for capital gains tax and income tax could realistically take place. So that gap between 20 and 45 may be narrowed, and that could happen in a variety of different ways. But what you may have done there is deferred taking your profits at a time when the rate is 20% to a time maybe when if rates are equalised, such that you're paying 40 or 45% on those particular profits, and that would not have been a smart move at all. Conversely, if you're an optimist, and probably living in cloud cuckoo land in my mind, capital gains tax rates could fall. We may have the most crypto-friendly chancellor in the world come into government and they decide to waive all taxes on crypto. So obviously in that scenario, the person who deferred taking profits would be quids. So in short, if you have invested in Genacoin, or as I say, one of the many froggy or doggy coins out there, first of all, you're an absolute muppet. No, I think we've all been there. But secondly, the negligible value claim is your busy mate at this stage. Let's get one filled in. Let's bank the loss. And again, whether it's a case of deciding to keep the coin, or let's face it, in many scenarios, there's no way that you're going to dispose of it, or selling it is going to cost more than it's worth. It's just there hanging around on your wallet, until, as I say, it resurrects itself like Lazarus, and you'll be thanking me for alerting you to the negligible value claim. Is there any benefit of being treated as trading for tax purposes? Yes, there is. If you make losses, let's talk about if you're an investor and you're within a capital gains tax regime. To start with, if you make a loss as a capital gains taxpayer, then you can either offset that loss against current year capital gains, or you can move it forward, carry it forward indefinitely against future capital gains. But that's pretty much it. Really, if you are classed as a trader, so you have trading losses, then those can be dealt with much more flexibly. So a trading loss can be offset against other income in the current year and the previous year. So if you've got employment income or any other income, you can use that to mop up the trading losses. And also there is special relief in the early years. So if you incur losses in your first 4 years of trading, you can actually carry that back up to 3 years against other income as well. Once you've exhausted all those potential routes, then you can carry it forward against the trading profits in the future. So the ability to utilize trading losses is probably the biggest benefit of being classed as trading. What you often see actually in the case law is that if somebody is arguing they are a trader rather than an investor, they're doing that because they want to access this really quite generous trading loss relief. And I guess the other side of the coin is HMRC repelling any such claims as mightily as they can. They're circling the wagons and making sure nobody gets the precious tax relief. So a lot of the case law in this area comes from that very type of scenario. The only other notable benefit perhaps of being classed as trading is that your profits in that scenario treated as earnings, hence why I spoke about the NIC. But if you have earnings, then that's usually pensionable income, so it'll enable you to make contributions into a SIP and get tax relief. But I must confess, out of all the crypto enthusiasts that I advise, they're not primarily concerned with how much they can put in their pension. The second point I would like to make is that you also need to think about where you're going. So yeah, fine, we might not having a tax from a UK point of view, but what about the place that we've moved to? What is the tax position there? we need to make sure that we're not jumping out of the frying pan into the fire. Now, if you come to a place like where I am at the moment in the UAE, in Dubai, then it's fine, because the UAE doesn't have any personal tax at all, isn't going to tax those gains. But if you were to go and live, I don't know, in the south of France, or in the US, or in Canada, or in Australia, then you really would have to manage your tax position in that jurisdiction as well. So that was the second point. So as I say, the two key points there: firstly, 5-year rule; secondly, not jumping out of the frying pan into the fire; and finally, if you're going to come and live in a nice sunny country like Dubai, you need to remember these. And also, don't forget your flip-flops, or as my kids call them, sliders. Okay, here's one cheeky strategy to escape tax on your UK capital gains on your crypto profits, and that is becoming non-UK resident. I described it as cheeky, but it's not something to be underestimated. It's potentially a big change in your lifestyle, and also there are a number of potential pitfalls as well. Okay, so here is the basic game plan, the basic set of tactics, back to sort of first principles for UK capital gains tax. CGT is a pretty retarded tax. It's very, very simple, and it only bites at the basic level if you are resident for tax in the UK. Again, under those basic rules, if you're non-resident, individual, company or trust, then there is no charge, basic charge to capital gains tax. Now, when you're looking at companies and you're looking at trusts, there's an awful lot of anti-avoidance rules. If you're looking at this as an individual, then there's one real provision to look at, and that is the temporary non-residence rule for capital gains tax purposes. And what the rule does is that it says, okay, you're non-resident, you have sold the asset, there's a gain there, but we're not going to tax you because you're outside the scope of UK CGT. We're going to wait 5 years. So if you come back to the UK at any point within 5 years of leaving the UK, then hard lines, we are going to charge that gain to tax. So if you come back in year 2, year 3, year 4, that capital gain will crystallize, it will resurrect itself like Lazarus, and you will be subject to tax. So you need to, if this is going to be your strategy, you need to be aware that you're going to have to be outside the UK for 5 years. And now, I'm a big fan of stating the bleeding obvious, but 5 years is a long time. So what are my final thoughts at the end of this video? If you stayed with us so far, then fantastic. Hopefully you've picked up some great tips on managing tax exposure and your taxes on crypto gains. Just to recap, first point of order is making sure you are recording all of your transactions. If you are even moderately active, abandon those spreadsheets, abandon Excel. Don't tell Microsoft I've said that, but abandon Excel. Invest in some proper UK crypto tax software. It's only going to set you back 100 quid, something like that, maybe a little bit more, but it will make your life so much easier. You will save not just hours, but maybe days and weeks, and or save time from your accountant or tax advisor, because it will essentially remove all the grunt work. It will pull in all the facts and figures from centralized exchanges, the wallets, through the sort of APIs and plugins that it has. It's a great tool. I can't recommend it enough. The second point is understanding the tax implications of your various strategies. As we said before, if you're HODLing, then really there's not a great deal to worry about from a tax point of view. Really, you just need to think about when you are taking your profits or not. You might like to think about actually some kind of sort of loss harvesting strategy that we've looked at, making sure that if you have got losses, can you use those in an effective way against gains? Should you be perhaps looking to cut some of those losses now, maybe using negligible value claims? You can use those, essentially carry those losses forward against future gains. So maybe just time to do a bit of fiscal spring cleaning there. Also, we talked about perhaps the sort of biggest option open to you. The most drastic option as well is perhaps looking at shifting your residence to a more, I guess, benevolent country when it comes to tax. As I say, 5 years is a big commitment. So really, unless the gains are astronomical, it has to be part of a wider desire, I think, to go and live and experience a different country. And that could be part of a retirement plan, part of a big adventure, part of getting a bit of sunshine. But if it's purely driven by tax, 5 years can be an awful long time. But for me, I think that's it for now. Hopefully you found the video interesting and you will tune in for any further content that we put out there. Thank you very much.